When you place a trade in modern crypto markets, you probably imagine a human counterparty on the other side. But that reality died years ago. Today, you are swimming in a dark pool, surrounded by silent, geometric algorithms designed to hunt. Every time a retail trader panic sells during a dip or buys the peak on pure impulse, they are feeding an emotionless machine. These algorithms do not hesitate or second guess. They are specifically programmed to harvest human emotional reactions and extract yield. We hold on to a comfortable illusion that artificial intelligence in finance is a helpful co-pilot, a neat tool to assist the worker. The reality is that these systems are being engineered to replace the human analyst entirely, removing the need for manual oversight. Predatory code has turned the exchange into an automated harvesting ground. Thousands of bots now scan social media tickers and execute trades in milliseconds, turning the unprepared trader into the machine's primary source of yield. To understand the scale of this mismatch, we can look at an experiment where aggressive manual traders with $10,000 accounts went head-to-head against simple automated trading bots for 30 days. The human traders relied on heavy conviction. They read the market momentum, swung for the fences, and executed massive, aggressive manual positions, hoping for quick spikes and profit. This bar chart displays the profit and loss totals at the end of the 30-day mark. In the short term, the human traders vastly outperformed the machines, leading many to believe that intuition still held the edge. Looking closer at the daily progression on this equity graph, the human trajectory is chaotic. It shoots upward in flashy, high adrenaline spikes, capturing massive, concentrated bursts of profit through sheer aggression. Right below those spikes sits the machine's equity curve. By comparison, it is slow, heavily statistical, and almost mathematically flat. Winning a short-term race creates a deadly false confidence. Manual traders are optimized for fleeting moments of explosive growth, but surviving financial markets requires enduring time itself. When we extend the x-axis of this chart to cover a full year, we see a sudden, violent collapse in the human's trajectory. Over 365 days, the physical toll of trading takes over. Human operators get sick, they grow exhausted. Most importantly, they develop deep emotional attachments to losing trades and actively ignore their own stop-loss signals. When an asset's price plummets, human intuition often tries to catch the bottom. Traders rely on gut feelings, holding on to toxic positions during a catastrophic drawdown. Bots operate on the law of large numbers, executing simple trend-following systems across dozens of markets. Zero ego. Zero fatigue. The line relentlessly curves upward, completely eclipsing the human returns. Pride and physical exhaustion are systemic vulnerabilities in the human code. These algorithms are mathematically programmed to locate and exploit those exact psychological breaking points over the long marathon. Those simple trend-following bots are already becoming obsolete. The market has moved beyond simple buy low, sell high logic into a phase where the machine makes every decision. We are now dealing with true ghost machines. These are fully autonomous AI entities that operate, analyze, and execute without a human in the loop. These autonomous agents perceive the world by extracting and analyzing data from Twitter and news feeds in real time. They provide thoughtful insights and take actions based on social sentiment faster than any Goldman Sachs analyst. They do not need a human to hit a button. These agents control decentralized crypto wallets. They replace traditional organizations, managing huge investment funds and allocating capital to startups. The ELIZA framework, for example, allows the creation of these agents, which have already reached billion-dollar valuations. These machines evolve their own thinking in real time, publishing their logic to the network. These agents are also beginning to collaborate. New AI ecosystems allow multiple agents to talk to each other, debug their own strategies, and operate collectively as a decentralized hedge fund. This billion-dollar scale is driven by a shift in how value is measured. These agents generate value based strictly on the attention they are able to capture. In this decentralized economy, attention has become the new global currency. The traditional model of trading finite hours for a fixed wage faces a math problem. A human worker is capped by biology. But an AI agent can manage 10 newsletters, automate multiple video channels, and identify undervalued assets simultaneously. This environment has created the Solo Quant. Instead of fighting the algorithmic tide, this new architect survives by leveraging machine precision. The Solo Quant treats AI as an army of digital employees. They use LLMs to find data arbitrage loops and run automated operations that would otherwise require an entire office of human staff. Every single participant now faces a choice. You can remain the retail target continuously hunted by predatory algorithms, or you can step back and become the architect who owns the bots. The technological barrier to entry has dropped to zero. Because anyone can now deploy these systems with a click, the only remaining barrier between the hunted and the hunter is absolute focus. Wealth is now a measure of how many automated systems you have working for you. Capital in 2026 isn't earned by working for money. It is generated by building systems that print it while you sleep.